Welcome to this explainer. Today, we're diving into something super fascinating that's unfolding right now in the financial world. We're looking at DBS Group Holdings, and honestly, they're undergoing a massive transformation. They're going from your traditional run-of-the-mill bank that just relies on interest rates into an absolute powerhouse of wealth management and tech. If you follow Asian markets, you already know DBS is a giant, but what they're doing right now, it's completely rewriting their future.
So, here's our game plan for today's explainer. We're going to kick things off with their financial performance, then explore those new growth drivers in AI and wealth. After that, we'll break down the returns and valuation, and finally, wrap up with the macroeconomic risks you definitely need to keep on your radar.
All right, let's jump right into Section 1 of Financial Highlights and Performance.
Okay, so these numbers, they tell a seriously powerful story of a legacy institution reinventing itself. In the second quarter of 2026, DBS pulled in record quarterly profits of 3.08 billion Singapore dollars. That's a solid 9% bump year over year, and it totally beat market expectations. But you know what's really wild about this? It's not just the sheer size of the profit, it's the environment they did it in. We're talking about a time of falling interest rates, which, usually, totally crushes a traditional bank's profit margins.
This perfectly illustrates the structural shift they're making, because their net interest income did take a hit. It fell by 3% because of those lower rates, but their net fee income absolutely defied gravity. It surged by 25% to a whopping 1.46 billion Singapore dollars. So instead of just taking the hit from that headwind, they totally flipped the script by leaning hard into their fee-generating services.
And when you really look closely at those fees, wealth management all by itself jumped an unbelievable 42% to reach $919 million. It's clear as day, they are actively pivoting away from just being a traditional lender. They're becoming a premier wealth manager and a true technology partner for their clients.
Now, absolutely crucial point here, this lightning-fast growth hasn't come at the cost of stability. Their non-performing loan ratio is sitting at a really resilient 1.0%, and they've backed that up with a massive $2.4 billion safety net in provisions. For us as investors, that's a serious shock absorber against any economic downturns. It proves they've got the rock-solid balance sheet needed to support all this ambition. Which brings us nicely to Section 2, New Growth Drivers. Let's talk about their wealth and AI engines.
The first massive engine driving this whole transformation is, you guessed it, wealth management. DBS just crossed a huge milestone. Their assets under management, or AUM, just broke past half a trillion Singapore dollars, specifically 516 billion. That's up 17% from last year, and it was fueled by a huge $11 billion in net new money just pouring in. Why does this matter? Well, wealth management gives you sticky, recurring revenue, and markets absolutely love that. It shows they're successfully winning over high net worth individuals across Asia who want professional management. And they are not stopping there. DBS has put it out there. They are publicly targeting $1 trillion in AUM by 2030. Think about that for a second. If they actually hit that aggressive target by the end of the decade, the fees from that asset base are going to completely dwarf whatever they used to make from regular old lending. Literally, it permanently rewrites the DNA of the bank. Of course, to attract $1 trillion in wealth, you need some seriously top-tier tech. And DBS is already sitting pretty as one of the most digitally advanced banks on the planet. They've got over 10 million users engaging with their AI assistants, DBS Joy and Digibot. Plus, they're launching some super innovative stuff, like offering 1-gram tokens of physical gold for retail investors. I mean, that level of digital innovation is a massive neon sign saying they are building the bank of the future.
A prime example of this tech push is their upgrade to something called agentic AI. Now, we're not just talking about some clunky chatbot that gives you generic answers. These AIs can actually complete active tasks for you. This is a total game changer. It slashes their operating costs, makes the customer experience way smoother, and honestly, the best part, it frees up actual human bankers to focus 100% on that high-value wealth advisory work we just talked about.
Okay, moving right along to Section 3, Shareholder Returns and Valuation.
So what does all this tech and corporate success actually mean for the bottom line? Well, shareholders are reaping the rewards right now, thanks to a very generous capital return policy. Case in point, an August dividend of 81 cents per share, which bundles together their ordinary dividend with a special capital return.
When you annualize that payout, it puts their dividend yield firmly in the 4.4 to 5.7% range. And you've got to remember the context here. Snagging a yield like that for a stable blue chip stock,
Especially in a low interest rate environment, that is a highly attractive setup for investors who want reliable income but still want to see some growth.
Now, the stock has had a fantastic run. It's up over 35% year to date. But it seems like the broader market is still kind of trying to digest this whole new growth story. If you look at 16 major analysts, the consensus is a buy with a target of around $75.39. But wow, is there a sharp split in opinion? The bearish models see a fair value closer to $70, hinting it might be a bit overvalued right now. Meanwhile, the bullish models have it pegged way up at $92, calling it significantly undervalued. That massive gap basically tells us one thing: future price bumps rely entirely on management proving they can consistently hit those aggressive wealth and AI targets.
Which brings us to our final part, Section 4, Navigating the Investment Risks.
To keep things completely balanced, we absolutely have to look at the macroeconomic hurdles here. First up is global geopolitical volatility. Things like the ongoing conflicts in the Middle East and global trade tensions, those could easily ripple out and impact the regional economy. Second, regional exposure. DBS has a huge footprint in Hong Kong and China, meaning any economic slowdowns or stricter regulations there could put a real dent in their loan book. And third, interest rate reversals. Yes, they've navigated the current cycle beautifully, but if rates were to suddenly, unexpectedly spike, that could put a lot of stress on borrowers and push those non-performing loans up.
Luckily, the management team is incredibly experienced, and they've built up those strong capital buffers we talked about just to handle issues exactly like these. But as we step back and look at the big picture, I want to leave you with one big thought to chew on. Can DBS actually power through and hit that massive $1 trillion wealth target by 2030? Or are these regional macroeconomic risks going to end up slowing down their incredible momentum? Really, that is the ultimate question for anyone watching the Asian financial space right now. Anyway, thank you so much for hanging out with me for this explainer, and as always, keep learning.